millennials especially got, finally off the fence out of their parents' houses or apartments and started buying houses for themselves, because we wondered when they were going to be buying homes, because we expected them to really pull us out of the 2012, 13, 14 stuff, from the previous recession in 08 through 010 or 2010. But they didn't. They stayed either in their parents' houses or renting with other, friends. And then finally, when rates got so low, they started buying in droves. So that created another demand there. Now, interest rates stayed low specifically because the Fed continued to buy these mortgage-backed securities, hundreds of millions a month. And they finally, towards the end of last year, said, okay, inflation's starting to get a little crazy. And we hadn't seen the real inflation numbers yet, but they knew it was finally coming. So that's when they said, we're going to taper this purchasing of mortgage-backed securities. So they slowed it rather than just quitting it. They have a couple different options. One, they can continue to buy. Two, they can slow their purchases. Three is not do anything at all. And then fourth, and that's kind of where we are now. They're not buying any, they're not selling any. The fourth would be actually the selling these mortgage bonds, right? Instead of purchasing. That would cause a major, major problem, because again, just like purchasing causes the price to go up, selling will cause that price to go down, which would cause interest rates to rise even more. So they're really just kind of, and these loans get paid off naturally anyway. The bonds get paid off naturally because people sell a house and move, and then that loan gets paid off, right? So that happens naturally anyway. So they're just letting those kind of settle, and then they'll eventually get paid off one way or the other. But that's what's causing interest rates to go down. And then when